Are you interested in learning more about the PEG ratio through both visual and explanatory analysis? Well then, you're at the right place. Welcome to Investinati, your go-to resource to weather all market conditions. Today, I'll be walking you through the PEG ratio in 4 easy steps. First is to walk through the definition of the PEG ratio. The second is to go through the calculation. Third up are going to be some explanatory examples. And lastly, we're going to consider some of the limitations of the PEG ratio. And just as a general reminder, I am not a financial analyst. Take what I say with a grain of salt. Remember, your investment decisions are your own. Great, now let's begin. So let's start off with the definition of the PEG ratio. PEG stands for price to earnings to growth. It is a valuation of a stock compared to its expected EPS growth rate, and its use is in being able to provide a comparison metric between stocks in the same sector or of the same type. I'll go through this in a little more detail in just a second. Now let's walk through the calculation of the PEG ratio. Now the PEG ratio is equivalent to the price to earnings divided by the company's projected EPS growth rate. As we know, the PE is equivalent to price divided by earnings per share. So thus, when calculating the PEG ratio, we need 3 values: the price of the stock, the earnings per share value of the stock, and the company's projected earnings per share growth rate. Great, now that we know this, let's walk through an example. Imagine we have a theoretical painting company, company ABC. Now, company ABC has a current market price of $10. It also has an EPS of $2, and its projected EPS growth is 10%. Now, let's walk through the calculation together. So our formula is going to be PEG is equivalent to price divided by EPS divided by growth. With the price of $10, we divide that by the EPS of $2, and we divide that by the growth of 10%. Now, $10 divided by $2 leaves us with 5. We divide that by the 10%, and our PEG ratio is 0.5. Now, what does this mean? Well, it means that company ABC's PE is currently at half of its projected EPS growth. Or in other words, company ABC's EPS growth is expected to be twice as much as its current PE ratio. In general, a company with a PEG ratio below 1 is considered to be undervalued, whereas a company with a PEG ratio above 1 is considered to be overvalued. But is this always the case? Well, not quite. I'll walk you through an example in just a moment to clarify this. But first, let's look at how we can use the PEG ratio as a comparison metric. So there's a concept known as comparing apples to apples rather than apples to oranges. And I'll walk you through how this can apply when using the PEG ratio as a comparison metric. So for the first example, we're going to be looking at the sector. Imagine we have 2 companies in the tech sector and 2 companies in the oil sector. Comparing the 2 companies in the tech sector may tend to have a higher PEG ratio than comparing 2 oil companies, or vice versa. Given the variance in the average PEG ratio of a certain sector, it may be more helpful to compare tech companies to one another rather than oil companies to a tech company. Something else that should be taken into consideration is the stock performance. If we have 2 stocks, one of which is on a bullish trend and one of which is in a bearish trend, it may not be as helpful given that their trends may continue. So although a stock may be considered under or overvalued, it may not make a positive or negative connection just yet, simply due to the momentum. We also have the market price variance. Comparing a penny stock which is trading at 75 cents to a stock trading at $100 may not be as helpful as comparing 2 stocks which are close to 100 or 2 penny stocks to one another. We also have the PE ratio itself. If a company has a high PE ratio, for example, at 400, and we try to compare that to a company with a low PE ratio of 10, it may not be as great of a comparison as if we compare 2 companies with low PE ratios or 2 companies with high PE ratio. Great. Now that we've considered this, let's go back to our example and compare 3 companies which we assume to be similar. Here are the 3 companies. We have company ABC, company EFG, and company XYZ. Now, company ABC has the PEG ratio of 0.5. Company EFG has the PEG ratio of 1, and company XYZ has a PEG ratio of 2. Now, the sector average is a PEG ratio of 1. So when we compare each of these companies to the sector average, we can see that company ABC is undervalued, company EFG is at the sector average, and company XYZ is overvalued. This gives us an example of how we can use the PEG ratio as a comparison metric between companies to see which can be considered undervalued or overvalued based on the sector average PEG ratio. When thinking of this example, we have to consider what the time frame is. In this case, it would be 1 quarter or 1 year, but companies are likely to have varying PEG ratios over time. Let's look through a graph to compare 3 companies and consider which of them would seem to be a better investment decision based on how its PEG ratio is changing over time. So here's this graph of 3 companies and their PEG ratios over time. We have company A, which has a decreasing PEG ratio over time. We have company B, which has an increasing PEG ratio over time. And we have company C, which has a somewhat steady PEG ratio over time. When looking at these 3 companies, consider which you think is undervalued, overvalued, and at the sector average. We know that PEG ratios below 1 are considered to be companies that are undervalued. So when we look at the first time frame in 2024 Q1, we can see that company A is considered undervalued, whereas company C is considered overvalued. However, over time, we can see the change in these trends. Company A's PEG ratio actually increases, which makes this company potentially be overvalued. Company B's PEG ratio decreases, which makes this company be undervalued in the long run. This is an example of how the PEG ratio can show us changes in how a company is doing relative to its PE ratio and growth rate. And I'd like to go through company C as well. Company C is showing a general, somewhat steady trend over time. Does this make it a bad investment decision? Well, not quite. This company is showing that relative to its price, it is growing at a consistent rate, making long-term investors which want to invest in a relatively safe company more likely to be attracted to these type of companies. So remember, you have to take into consideration what type of investor you are, whether you're considering short-term, long-term investments. Great. Now let's consider some of the limitations of the PEG ratio. To start off, we have that the earnings growth estimate is just that, an estimate. It is almost impossible to predict what is going to happen over time. Given these are estimates, they will not be accurate and things will change, thus making the PEG ratio be limited. Also, we have to take into consideration abrupt changes such as recessions or the COVID pandemic. During the COVID pandemic, many stocks decreased to levels lower than the previous year. Does this mean that all stocks were undervalued or all stocks were overvalued? Well, not quite, given that after the COVID pandemic, not all stocks were able to recover to their previous levels. Next up is the ability of a company to manipulate the PE ratio. Companies are in control of their earnings per share, given that they can change the number of shares openly traded in the market. Thus, they would be able to change the PEG ratio as well. So when making a PEG ratio comparison, it may be helpful to consider whether or not the company has recently changed the number of shares available to trade in the open market and how this might manipulate the company's current PEG ratio. Lastly, we have the concept of limited comparability. Remember the topic of comparing apples to apples rather than apples to oranges. If we have 2 companies, such as one in the tech sector and another one in the oil sector, it may not be as helpful as if we compared 2 tech companies to one another or 2 oil companies to one another. Great! Thanks for joining me here at Investinality, your go-to resource to weather all market conditions. Make sure to subscribe for my future videos, drop a like, and comment below with other terminology you'd like me to go over. I'll take a look and make sure to make some videos of it. Happy investing, and until next time.